Okay, we're going to look at
Exercise 5-4. This one we're going to look at things from the perspective of the seller, right? So we're going to record sales transactions and sales returns and sales allowances and those kind of things. This is the other side of the exercise 5-3, right? 5-3 we're a buyer, here we're a seller. The only exception again is the very first transaction. May 3rd, Allied is us, so made its first and only purchase of inventory for the period of May 3rd. 2,000 units, price of $10 per unit for a total cost of $20,000 bucks. All they're saying is we bought $20,000 worth of inventory to sell, so here we're a buyer because we can't sell stuff without buying it, right? So that's our very first transaction. That's a lot like exercise 5-3. Now, however, we are going to get to the selling of things right on May 5th. May 5th, Allied sold 1,500 of the units of inventory for $14 a unit. Invoice total $21,000 to Macy Company under credit terms 210N60. The goods cost Allied $15,000. Remember that we're in a perpetual inventory system, so we always want to keep this merchandise inventory account up to date. So when we sell something, we're going to sell it and we're going to record the inventory accounts that go along with it. So we're selling this on account. We're offering them a discount of 2% if they pay within 10 days, but we're gross method, so we just do what accounts receivable and sales, 1,500 units times $14 for the $21,000 in the sale. But I'm not done yet, right? Because now I don't have those 1,500 units anymore. I sold them, right? So, in the cost of goods sold, we debit. Remember, this is our expense account that deals with inventory. We debit cost of goods sold to increase it, and we credit merchandise inventory to decrease it, right? So we had 20,000 in inventory. We sold 15,000. We've only got 5,000 left, right? We sold 1,500 units, and they cost us $10 a piece. Now, pay attention to those numbers, right? This is what we sold it for when we recorded the sale. This was our cost of goods sold, the cost of those things. So essentially, we made $6,000 in gross profit on the sale, right? Key thing to remember when you're a seller is you have to record both the sale and you have to update your inventory accounts as well, right? A little more complicated than being a buyer. Macy's returns 125 units because they did not fit the customer's needs. Invoice amount $1,750. Allied restores the units, which cost $1,250 bucks to inventory. So they just brought them back into inventory. Right? Our customer returns 125 units, and we just put them back into inventory. Now, it's like unselling them, right? So we're just going to kind of undo that. But remember, we have this sales, returns, and allowances account. That's contra revenue, right? So we book the return against that, and we take it away from the accounts receivable. So that's the sales part of it, right? We returned, or they returned $125 worth. We sold them at 14. We bring them back at 14. What else happened, though? We now have those goods back in our inventory, and they're not sold anymore. So we just undid this entry first, and then we undid the inventory entry, right? Cost of goods sold, merchandise inventory. Then the return is just flipping it around, right? Just flipping it around. So that is the sale, that is the return. Look how much more complicated this is than buying, right? So we have to do 2 entries for every time that we have one of those transactions, right? May 8th, Macy's discovered 200 units are scuffed, but are still of use and therefore keeps them. We, Allied, send Macy a credit memo for $300 towards their original invoice to compensate for the damage. So we sold them crappy inventory, right? So now we're going to give them an adjustment. We're going to give them a $300 break, right? So we're going to reduce their account receivable with a credit, and that goes against sales, returns, and allowances because we want to keep track of those allowances and those returns, right? So let's see where we are right now, right? We sold them for $21,000. We had a return of $1,750 and an allowance of $300 bucks, right? So they owe us, well, whatever that difference is. I don't have the math in my head, right? But we'll take a peek at it. Allied receives payment from Macy for the amount owed on May 5th. Purchase payment net of returns, allowances, and discounts. So they're not going to have to pay us that whole amount because it's a discount and we have to deal with those returns. Let's just look at the entry, right? Okay. They owed us $18,950. That would be the $21,000, right? Minus that $17,50 minus that $300, right? So $21,000 minus $17,50 minus $300. That's how much of the account receivable goes away, right? Now they get a discount of 2%, but they only get a discount on what they owe us, right? So we take that $18,950 times 2%. That gives us $379. That's the discount, right? Now sales discount contra revenue account, right? Reduces the amount of revenue, and cash is a plug, right? $18,950 minus $379 gives us the amount of cash that's paid. So this one was a little more complicated, right? Because we had some returns and we had some allowances, and the numbers weren't nice and simple, right? But we get to that $18,950. We know that all goes away. We compute the discount and back up into the amount of the cash payment. So that's how we record sales transactions in a merchandising business.